All right, welcome back everyone to Lunch at the Market. I don't know about you, but it's really nice to have a refreshing day when the world isn't going to heck in a handbasket. There really isn't a ton on the table today for big movers, so we are really just cleaning up our books. All right, it's probably time to call it a day on the AKAM March 40-35 put spreads that we're short. We prefer to be short the April 36-30 put spreads, so we rolled down and out to get there and basically had to double the size of our position in order to do so for additional credit. I know that we harp on position size all the time, that and having available cash, but we can't be too clear on these two incredibly important mechanics of trading. One, always keep cash on hand so you can take advantage of frequent and volatile drops, moves, shifts, and other trading activity. And then two, you need cash for trade repair. I cannot emphasize those too much. Two, keep your position size in check so that you can add on big declines and increase the size when you have to do trade repair. For instance, think about last month when we added to GPS, that's the gap, we were massively out of the money and wrong on our GPS long calls. We basically doubled down on the position and ended up 600%, which was a huge winner for last month. Okay, those things can only be done. You can only basically, if it'll feel like throwing good money after bad, but you can only do that if you have an appropriate position size. If you can't afford to lose 100% on a long call, then your position size is probably too big, because that's what you face if you're wrong and you're long on options. Okay, we did get a fantastic opportunity this morning to clean up our WFT, that's Weatherford collar. Several weeks ago, we flagged stocks like Chesapeake, Weatherford, JDS Uniphase, NVIDIA, and others as great candidates to put on a collar. All right, for all of those, you need to be brought up to speed. Remember, a collar is long stock, okay, and then you add an upside call that you're short and a downside put that you're long. For instance, on Weatherford, we were long the stock, and then we sold May 27 calls and used the proceeds to buy May 24 puts to put a collar on our long stock. Well, this morning when the stock was set to open around $19 and change, we immediately upon the open bought back our 27 calls. Just boom, took them off the table. So now we're no longer short those calls, which then allowed us to exercise our put, make somebody take our Weatherford at 24 bucks, even though we could buy it in the market for $19.65, which is exactly what we did. We grabbed a nice, healthy handful, about 300 shares of the stock at $19.65, boom, right on the open, right after we made somebody take it for 24 bucks. That is a huge, huge profit that we just took in for doing that. Okay? We put on the collar really at no cost or very little cost, and in some cases for those stocks, we actually took in money to put on those collars. That, friends, is why you put on a collar around a long stock. If you've got a stock that's just ramped up really big, you're really happy with the profits, but you kind of want to stay around in the stock just to see what happens, put a collar on that long stock. Okay? That way, you can hit the exit button if you get in trouble to the downside and the stock goes through it. You get to sell your stock for this price, and then if it goes up, well, you're forced to take your profits, but you have to sell eventually. Otherwise, it's the gain or loss doesn't really exist until you realize it. Okay, so don't let things sit on your balance sheet as a big gain. Otherwise, you could end up turning them into a big loser. All right, other trades today involve rolling our WBC in the money call spreads out because the top side of our strike is not in the money, which means what we wanted was a $5 wide spread, and what we have right now is about what we paid for it. So we want to roll out on the calendar, ideally out to September, which is going to get us through the difficult summer months without too much damage. Okay, in AXP, which is American Express, we rolled that. We had a put butterfly on. Remember, a put butterfly is just a long put spread and a short put spread together on the same stock, and then we basically did this, right? So we basically sold the top strike, which was the 45, and bought more of the 38s, and then we just simply ended up with more short 42-38 put spreads, and then we actually added to that position selling more 42-38 put spreads all in July for American Express. We're long the stock. We had the put butterfly on to protect us because the stock looked weak and there was some bad news hitting it. There was a lot of headline risk, and of course it's caught up in the whole financial regulatory reform, Durbin interchange, all that stuff. So we wanted to hedge. The hedge worked out terrific. We sold those. We took in $3 per contract, right? $3 to sell this and then go buy sell the 45 put and go buy the 38 put. Then we took an additional $1.33 for selling more of the 42-38 put spreads. All this money that we're collecting, taking in, is used as a hedge against our long position that we want to stay long. So we'll just basically sell spreads against it to lower our cost basis on the American Express, right? We're going to collect the dividend, and then eventually our cost basis is going to be so low that we've got around a 25 to 30% gain on the stock. And at that point, it's really just up to us what we want to do with the stock. We can blow out of it, keep our 30% profit. If we think there's additional upside, we can do that too. So we like to use options as a great hedging strategy, and putting on some of the more complicated structures allows us to have multiple exit strategies once the event happens. Okay, remember all those options on American Express are out to July. Now, it wouldn't be a day at Night of Opus Financial if we didn't sell a put spread on something, right? And of course, Netflix is weak again today. It's actually the only thing that's really red on our screen. So we took the opportunity, sold some 190, 185 put spreads in March, right? So whoever bought those from us is running out of time. They only have 16 days left to be right. Calendar's really moving in our favor, and those out-of-the-money options premiums are starting to go down pretty significantly. So we wanted to take advantage of that by selling more 190, 185 put spreads for March. We've already rolled out, down and out, all of our March 210, 205 put spreads that we were short. We really don't want that thing to go to $5, which is really what it's worth right now. But thankfully, because of volatility and time value, right, that spread's only in the $2 range. So we roll those down and out. Of course, I had to make the position size bigger in order to take an additional credit. So today we're really working on just cleaning up our portfolio. Don't get lulled to sleep by today's sleepy action. Cut bait with your losers. Look, if they're not coming back, you need to roll those suckers out on the calendar or just realize the loss. Okay? You got 16 days left. Enjoy the rest of your afternoon, and we will see you guys tomorrow. Thanks for joining us again today on Lunch at the Market.